Germany's economy has long been seen as the engine driving the EU to become one of the world's richest trading zones. But now the economic powerhouse has hit a roadblock in the form of the damaging trade war between the United States and China. Growth in Europe's largest economy reversed in the second quarter as exports fell more sharply than expected. And anticipated fallout from Brexit is also fueling fears that the German economy could slip into a recession. GDP growth fell 0.1% in the second quarter compared to a 0.4% expansion in the first 3 months of the year. Analysts say slumping exports and a slowdown in the construction sector were the main culprits behind Germany's slowdown. And the Economy Minister Peter Altmaier has called the contraction a wake-up call and a warning signal. But the government remains optimistic that the economy will grow slightly this year, saying further fiscal stimulus isn't yet necessary. Well, for more on this, let's bring in Ira Spitzer from Berlin. Hi, Ira. Well, the latest GDP figures confirm what many had been fearing, and that's a slowdown in Europe's largest economy. Tell us more about what was behind this disappointing result.
Well, the results out of Germany seem to really come down to one major factor, and that is exports. Germany is the world's third largest exporter. Exports account for a much larger percentage of this country's total GDP than most countries around the world. So given the uncertainties about the situation with Brexit, given the trade war between the U.S. and China at the moment, it really is anything but business as usual around the globe. And it appears that Germany's exporters have now really been hit by these structural changes in the world economy. And speaking of China there, we saw that Chinese factory growth had slowed. That was also something that had disturbed markets globally, in addition to these German numbers. But with a slowdown in China, Germany's automotive industry is very dependent on Chinese consumers for growth in that sector. So really, when you look across the board, Germany just had a lot of headwinds considering the global outlook. And it wasn't really a surprise necessarily that the economy slipped in this quarter. But if it slips again in the next quarter, then Germany would technically be in a recession. And that would certainly be something that would be very worrisome both here and across the Eurozone and even in the global economy because of the size of Germany's economy.
That's right, and Germany has long adhered to a zero budget deficit policy, which means that successive governments have been quite loath to spend or borrow money. Do you think that might change with the threat of recession looming, as you've pointed out?
Well, Germany's influential BDI Industry Association came out today and wrote an article in a newspaper here saying that it was time to abandon what in Germany is called the schwarze Null, the black zero, and that is this adherence to a balanced budget at all costs. And essentially this industry association said that if you look at the options available to the German government, there really are compelling reasons to abandon that policy, perhaps the most obvious being that they are able to borrow at negative interest rates. So the Industry Association encouraging the German government to use debt to finance public spending and really to sort of change one of the core tenets of its philosophy. Now, it's hard to see whether that, or it's hard to say whether that will really happen. A German government spokesperson earlier pointed out that despite the slowdown in the second quarter, that Germany is still expected to grow by about 0.5% this year, so kind of downplayed those calls. But they're certainly growing louder here in Germany. I don't think we've seen the end of this, and the government is certainly going to have to think pretty hard about whether it wants to shoulder the blame, especially if we see another quarter of slowdown, which would, again, put Germany in a technical recession.
Now, Wall Street is currently being battered by the inverted yield curve phenomenon on US and UK bonds. That's when returns on short-term Treasury notes eclipse those of longer-term bonds. And in the past, that's been a reliable indicator that a recession is on its way. Is that something that's likely to weigh on the German government's mind as well?
Well, if you subscribe to the philosophy that those indicators are solid indicators of a recession on the horizon in the United States, then yes, that is something that the German government would have to pay very close attention to, because if there's a slowdown in the US, it's going to be extremely hard for Germany to avoid the contagion from that. Now, again, I think I don't know the exact thinking of the German government here, but as I mentioned before, I do think that Germany is seriously considering some sort of economic stimulus in order to counter the possible effect of a recession potentially in the United States, and certainly the ongoing trade war between the U.S. and China, where Germany has been caught in the crossfire when you look at some of these the situation with exports here.
We're seeing there the Dow Jones down almost 2.5%. Ira Spitzer from Berlin, thank you.